Good afternoon, this is Sean Golden with Golden & Golden, here to discuss the basics of how do you treat foreign mutual funds for tax and reporting purposes. I know it's a total incredible headache. The information online is deceiving. It makes you feel like any mistake you make is going to result in some significant tax liability, tons of fines and penalties, etc., etc. As with everything else in tax, it generally doesn't work that way. Let's go through the basics, right? So when you have a foreign mutual fund, there's two key components, right? There's the reporting component, and then there's the tax component. One really doesn't have anything to do with the other in the sense that even if there's no tax impact, it's still reported. The foreign mutual fund is generally going to be reported on the FBAR, foreign bank and financial account reporting. If it's an individual mutual fund, for example, then you would report individual fund. If you have it in an account, let's say, and you have the gross value of the account, generally you can report the account value without having to parse out each mutual fund, but different practitioners do it differently, so something to consider. Form 8621 is generally going to be required when you have foreign mutual funds. That's because they are PFIC, which I'll get to in a moment. There's some exceptions for 8621. The key one is normally if the value is under $25,000 if you're single, married filing separate, or $50,000 if married filing joint. But there is some discrepancy between the instructions and the regulations, and generally you may still be required to file the very top part of the form, similar to filing a dormant 5471. The form is still required even if there's no tax return that's required, similar to other forms like the 3520 and the 5471, the FBAR as well. So what makes the foreign mutual fund and other equity types of funds such a headache is that it's considered a PFIC. A PFIC is a passive foreign investment company. Most people would think of it as, for example, maybe you have a Hong Kong Limited or a BVI, you own a bunch of investments in it. That's a holding company. It operates for the sole purpose of generating income and holding that money. So that would make sense, right? But the IRS likes to make things incredibly unnecessarily complicated. So even that fractional ownership you have in a mutual fund is going to be considered a PFIC as well. Baseline perspective, 75% of the income or 50% of the assets, or more than 50% of the assets are passive in nature, then it's going to qualify as a PFIC. And again, that leads you to Form 8621. Now, prior to 2012 or 2013, I always forget off the top of my head, I think it's 2012, you only had to file the 8621 normally if you had what's called an excess distribution. You redeemed the mutual fund, or you had dividends, for example, that when averaged exceeded 125% of the 3 prior years, or less if you held the PFIC for less. But starting in 2012 tax return, you have to file it even if you have no excess distributions, unless the exception qualifies. There's a few other exceptions as well, but the 25,000, 50,000 is the main one. So tax treatment of the foreign mutual funds. Reporting, you have to report it, right? Unless an exception applies. Tax treatment's a little more complicated. If there's no distributions, that generally means there's no tax. It's not like when someone owns a stock, for example, and a stock account, it generates income. It may not be distributed, it's still taxable because it's accrued. When you have a foreign mutual fund, it's a little different. If it accrues, well, the growth in value, excluding accrued dividends and other income, is not taxable. You bought the fund for $10,000, now it's worth $20,000. You haven't sold it or anything. That's not taxable, right? But the accrued income is normally not taxable as well unless it's distributed. But, and this is very important, once it is distributed, then generally it's going to be an excess distribution unless you've been receiving similar incremental distributions each year. And what does an excess distribution mean? Well, it means any portion of it, which is normally more than 125% of the 3 average years. It's a whole equation, but I have other information online that you could find as well on that specifically. But you get taxed strangely. It's like a penalty, but they don't call it a penalty. You get taxed at whatever the highest tax rate is in the years you held it. You held it from 2010 to 2020. You look at what the highest tax rate is during the year, 37 or 39.6, and you get dinged each year for the incremental value associated to that year. So in other words, that's a long-winded way of trying to say you don't get long-term capital gain or qualified dividend treatment on the excess distribution. Super important, because what you think is long-term capital gain can turn out to be taxed at the highest tax rate, and then the current year that you sell it or redeem it, switch it out sometimes, then you're going to get hit at whatever your progressive tax rate is if you're in one of the higher tax brackets. Then at the end of the day, you may negate any benefit that you thought you were receiving throughout the life of the mutual fund. You might have been better off just investing in a U.S. mutual fund. So that's something to consider. The IRS has been cracking down a lot on foreign mutual funds, as of late. If you're out of compliance, you may want to consider one of the compliance programs. There's VDP if you're willful. You just can't certify under penalty of perjury that you're non-willful. If you're non-willful, there's a lot more options available. Streamlined filing compliance procedures, domestic or foreign, depending on the residence of the taxpayer, reasonable cause, and delinquency as well. Those are alternatives to the streamline. We have lots of information available on our main websites and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate and something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.